Have you ever wondered how nice it would be to own your house mortgage-free? Have you thought to yourself, if only I can pay off the house early and save on tons of interest? Only if there is a better loan out there. Well, there is. You're thinking this because chances are you're stuck with the grind of paying down a 30-year mortgage. After months and months of payments, you notice that you barely touched the tip of the iceberg. You barely made a dent on the principal. After tens of thousands of dollars of payments you've made, the debt remains as large as it was in the beginning. If that's how you feel, you're not alone. You feel this way because your payment schedule looks like this graph on the right. Notice in the first 10 to 15 years of your payment, most of your money goes towards interest. Only a tiny portion goes towards paying down principal. By year 10, for every $100 spent, only $23 is applied towards your principal. By year 21, about 50% of the loan principal remains unpaid. In fact, look at the amount of interest you pay. For every $100,000 you borrow, you end up paying $116,000 in interest if the rate is at 6%. So in reality, in a 30-year mortgage, you end up paying twice the amount you actually borrowed. Well, we all know that borrowing money costs money, and we're told that the lower the interest rate, the less expensive it is. And we choose lengthy terms like 30 years to offset the cost. In fact, 90% of the loans in US are 30-year mortgages. The truth is, the total cost of the loan is only defined by three variables: the principal, the rate, and the time. Any increase in one variable increases the total cost. Likewise, a decrease in any one variable will decrease the total cost of the loan. So if you choose a longer term, like 30 years over 15-year term, then the cost of the loan increases. The sad truth is, most Americans choose 30-year terms and are entering retirement years with a mortgage. In fact, 50% of American households are not able to save enough to fund their current standard of living during their retirement years. For most Americans, their wealth is trapped in their mortgage. The banks get fat on all that interest they make off of the loan, while leaving you scrambling for funds and postponing retirement. I want to introduce you to a mortgage unlike any other. Unlike a traditional mortgage with an amortization schedule that forces you to pay more in interest than principal, this loan has no amortization schedule to hold you back. Because in a 30-year amortized loan, your loan balance reduces slowly, making your interest costs high, even at a lower rate. This loan calculates interest differently, so over time you pay less interest. It applies your monthly payment 100% towards your principal right from the very start, unlike a traditional mortgage where a small fraction goes into your principal at the beginning. This revolutionary product is called the AIl In One loan. It was pioneered by CMG Financial in 2005. It is designed to help borrowers pay off their principal balance significantly faster than a traditional mortgage and save tens of thousands of dollars in interest cost. This can be done without requiring you to increase monthly payments, nor does it require the interest rate to move lower. What you can hope to achieve with this loan is to pay down the balance 2 to 4 times faster without a change in budget, reduce monthly and lifetime payments without depending on lower rates, have access to your equity dollar in the house without needing to refinance or take out an additional loan. With this loan, you would have benefited by having reduced the cost of your property ownership. Remember, your payments are applied 100% towards principal from day one. Your interest is calculated consistently on a lower loan balance. You pay your home faster because less money is going towards interest. Each payment therefore reduces the overall balance faster. You free up income for other investments like a second home or stock market. The home equity aspect of the loan allows you to withdraw money when needed. The all-in-one loan is not just another loan. It's a solution to the loan itself. It gives you more freedom, more flexibility, more fortitude. It is a smarter way to borrow money. This is no longer your parents' mortgage. The 30-year mortgage might have worked for your parents, but it's not what's best for you. Plus, do you really want to spend your entire life working to pay off your home? Conventional mortgages have stayed the same since 1938, keeping borrowers in debt for too long. Stop wasting your money on costly mortgage interest when you can change the way your payments are applied, so you can retire safely, securely, and on time. I mentioned before that this loan does not require you to change your monthly budget or increase your minimum monthly payment obligations, because changing your spending habits is not as easy as it sounds. What is extraordinary about this loan is it combines home financing with personal banking in one account, so you don't have to change the way you spend to save thousands on interest. It is a loan designed with your lifestyle in mind. And if you are an investor, you will also love this loan. Let's delve into a real-world example. If you were to borrow $500,000 on a $625,000 home, taking out a 30-year fixed mortgage at 3% interest, you would pay $258,887 in interest. That is, for every $10 you borrow, you have to pay back $5.20 in interest. So borrow $10, pay back $15.20. After all said and done, the borrower would have paid $758,887 in total payments, principal and interest, which means the price of their home increased by 22% simply due to the interest cost associated with that financing. This is only assuming that you only get one mortgage. It does not include any refinances that you might have done during the life of the loan. 22% increase is significant. How many times have you factored into the interest cost you have to pay on your mortgage when you went shopping for a home? Typically, the interest cost is not something we factor in, but it is what we pay first in a month before anything gets applied to the principal balance. Now let's look at another example. 5% interest in today's market is pretty realistic. At 5% rate, you're looking at paying back $466,279 just in interest cost alone, which means for every $10 you borrow, you have to pay back $9.30 in interest. So borrow $10 and pay back $19.30. When we total up the principal and interest, it is a 51% increase in the price of the home. So in total, you would have paid $966,279 for the home. This is not including the initial $125,000 that you put in for the home at closing. Now, how would this compare to the all-in-one loan? Let's just assume 8 months later, we refinance this 30-year traditional loan into the all-in-one loan. The interest rate changes from a 30-year fixed at 5%. We're going to finance the loan into an all-in-one loan, and it's going to have a 9.39% variable rate. We're going to increase the interest rate by 4%. We're not changing anything about your spending habits, your budget, or your lifestyle. We're starting off with a balance owed at $495,123, which is what the balance would be after being in that mortgage for 8 months. Once refinanced into the all-in-one loan, without changing any spending habits, budget, or lifestyle, you are able to pay off in 11 years and 8 months versus 29 years and 3 months, and you're saving over $136,000 in interest cost. That's not chump change. $136,000, that could be kids going to college, could be helping our parents when they get older. That could be building your property portfolio, or investing in your retirement, or just doing better with the family household rather than giving it to the bank for the interest cost. And that is the power of the all-in-one loan. Every loan scenario is input into this loan comparison simulator. It is able to compare a conventional loan scenario to the all-in-one loan. After inputting basic parameters like loan amount, income, debts, the simulator compares the all-in-one loan to a traditional mortgage, just like in the previous example, for you to make an informed decision. This loan is not how your parents or grandparents mortgaged. It is an innovative way to put your money to work for you in exact same fashion how the banks are using your money today. The catalyst for this loan is the combining of home finance with personal banking. There is no need to overthink this. It is super simple. I'm going to ask you 2 questions. Every month or every 2 weeks or whenever you get paid, what do you do with your paycheck? Chances are you deposit your paychecks into your checking account. My follow-up question is, why do you use a checking account in the first place? We use it because it's safe, secure, and easily accessible. With the all-in-one loan, your money is going to stay safe, stay secure, and stay 100% accessible to you via the method you are already proficient at using. Every all-in-one account comes with a checking account backed with the Visa card, so you can use it everywhere Visa is accepted. You can order checks, sign up for online bill pay, there's mobile banking app, there's fraud protection, auto alert. So the account is going to look and feel and function exactly like a checking account that you have today. Only now we put that mechanism in place to put your money to work for you. Every time a deposit is made into the all-in-one loan, it doesn't matter the amount, it doesn't matter the frequency. Every time that deposit goes in, it is going to sweep into the mortgage side of the account and reduce the balance by the amount of the deposit. Easy enough, but we all have bills to pay, groceries to buy, activities to put the kids into. That sounds good, but we can't devote our entire check towards mortgage. Yes, by all means, you should buy those groceries, pay those bills, you should put the kids in those activities. Whatever you're doing with your money today, do tomorrow with the all-in-one loan. What we know is that money isn't spent out right next day you receive it. Money actually floats. It can sit idle for days, weeks, months before it is needed for bills and expenses. We know this because Census Bureau tracks consumer spending habits. So we leverage that understanding into the creation, development, and implementation of this product. It makes sense. We don't go grocery shopping once a month. We do that weekly. Our cell phone bills aren't due once a week. That is a one-time event per month. So think about how much money tends to sit idle waiting to be spent. While money is sitting around waiting to be spent, regular checking accounts earn close to 0% because standard cash accounts earn very little interest compared to what we have to pay out on our debt, including our mortgage. People brag about low interest rate mortgage, but their low interest rate mortgage costs them more interest. It is higher interest rate, high volume of interest paid out than any of their money will earn. So while we float a lot of money in our checking account, it does very little for us in return. But your money is 100% leveraged by the bank. They want you to park your money there because they benefit from that. Whether they use that for additional lending or investing, banks are 100% leveraging the money that sits in the checking account. You can sum up and say standard checking accounts provide very little value relative to the loyalty spent decades by customers. Of course, the traditional borrowing and banking process means there is this invisible wall or barrier between our liabilities, debts, and our cash. Our money doesn't get to engage our debts very easily. So we send over our payment, and that payment is amortized, and very little of that goes towards paying down principal in order to reduce our cost, our time, and debt. Over at the All-in-One loan, we break that barrier and we connect the two accounts together. When a customer deposits money into the All-in-One loan checking account, that money doesn't sit there idle waiting to be spent over time, earning close to 0%, but instead, it is sent directly over to the mortgage. Deposits are used automatically to lower the principal, daily loan principal, saving borrower more interest on their loan than they could have earned by pushing those dollars into a traditional checking account. Savings begin automatically and immediately. In the all-in-one loan, the concept is to give consumers the ability to leverage their own dollars towards their largest debt, saving them in interest and giving them more flexibility. It is very important to remember that money in your checking account you have right now could be used against your mortgage balance, saving you interest versus just sitting there benefiting the bank. So inevitably, when money is spent from the account, the balance is going to go up by the amount withdrawn. However, until you spend that money, it is going to stay in the account to keep your balance low, which in turn is going to keep your interest costs low. How are we calculating interest on this loan in the first place? I can assure you there is no amortized payment schedule. We do not predetermine a single cent of interest the client owes. It doesn't work that way. Instead, interest is calculated every single day. So once those dollars go in to reduce the mortgage balance, we will calculate interest on that lower amount. We're going to take the lower balance and times it by the interest rate, then we divide it by 365. And that is that day's interest cost. We're not charging it daily, we calculate it daily. That calculation is done every single day of the month. When that month is over, we total up those daily calculations, and that becomes the interest portion that gets automatically drafted from the account in the following month. So your interest is calculated simply, and you're paying your interest in arrears. There is no other loan in America that will allow you to pay principal first before interest is calculated. Another way to put it is the loan recasts daily. In a traditional mortgage, when you pay into that interest, you're not getting your interest recast. It is super important to remember that we separated the principal from the interest in the all-in-one loan. When you make a mortgage payment, it consists of principal and interest. In the all-in-one loan, those two are separated. The principal payment happens with every single deposit. We calculate interest on that lower amount and add it up for the month, settle it on the following month. That is when the interest portion is made. You must remember you're making the principal payment separate from the interest payment. You're not making one payment sent to the bank. The structure of the all-in-one loan is that it is a 30-year term. The amount you can draw up to is consistent in the first 10 years. We achieve a payoff at the end of 30-year term by reducing the credit line slightly after year 10. Starting year 11, we're going to reduce the credit line you have access to by the loan amount divided by 240. You're not required to make extra deposits after year 10. Often, folks are reaching their payoff at 8 to 12 years average. Even with the credit line reduced, folks continue to stay in the account because of the flexibility and functionality it offers. If you decide that you want to leverage and purchase another property, send your kids to college, go on vacation, you can. It is as easy as swiping your Visa card or writing a check during the transfer. Once you reach that payoff point, when your mortgage balance is zero, you have a few choices. You can close out the account, be mortgage free, or you can continue to pay the $60 annual fee and have access to the available equity dollars you have. It is entirely up to you. Once the mortgage balance is zero, you're going to see a positive balance on the checking account. I hope you got a glimpse of how the all-in-one loan can help you take back your financial independence and not waste your money on a mortgage that is slow, inefficient, which also requires excessive interest payments. The typical client in the all-in-one loan pays down their mortgage 4 times faster and pays down their principal by 13% more per year. The traditional mortgage is rigid and does not allow payments altered or any access to home equity. This all-in-one loan, clients have access to the money they paid towards their loan, as well as access to home equity for up to 30 years. Traditional mortgages are expensive. Typically, you pay $50 to $80 of interest for every $100 you borrow. The all-in-one loan is able to reduce the amount of interest by lowering the balance faster and cut out decades of interest payments. To recap all the benefits of this loan, you save tens of thousands on interest, allowing you to pursue other goals or reinvesting in real estate. It builds equity 2 to 4 times faster and gives you leverage when you sell in the future. It allows you to pay off your loan in half the time without requiring you to change your budget. Remember, with the traditional mortgage, you can't access your home equity without a refinance. The all-in-one loan gives you 24 access to this home equity. It is flexible enough to allow you to pay the minimum interest-only payment if needed. The all-in-one loan is one refi, one loan with unlimited opportunity. It is not just another loan, it is a solution to the loan itself. Some highlights of this program. There is no prepayment penalty or balloon payment. It allows 30 years of 24/7 access to home equity. Loan amount can go up to $3 million. Purchase or refi are all okay on all owner-occupied second home investment property. Condos, PUDs, single family or multifamily are all eligible. The rate on this loan is adjustable rate because it is a HELOC. We use the 1-year CMT index. The rate is capped at 6% above the entry rate, and the floor rate is at 3.75% or 4.75%, depending on whether it's an investment property or not. Rates are very competitive to conventional mortgage. You're welcome to contact me directly. I can run a simulation of your scenario to measure the potential benefits of this loan for you. It is 5 easy steps and takes about 5 minutes, and you will get to see the result. I basically collect information from the conventional mortgage you have in place or you're considering getting. I also collect information about your cash flow behavior like deposit and spending activities. Then I will let you know what the numbers look like if you were to go with the all-in-one loan. You will find out what the payoff time looks like, what the interest savings you can expect, what your effective APR looks like. It also allows me to stress test various scenarios you have in mind so as to give you a worst case scenario into the future. Please feel free to hit the like or share button and reach out with any questions you have.